Hey everyone, this is Andrew Jordan from NodeWise CPA. Welcome back. This is the final video in our series on under-the-radar tax strategies. We've already covered retirement plans, strategic depreciation decisions, and S corporations. Today we're going to wrap up with things I like to call a potpourri of unique strategies. These are more specialized tools that don't apply to everyone, but in the right situation, they can deliver some really powerful results. If you're in a managed service provider, a lot of these are not everyday tools, but they can matter in specific situations like higher profitability, bigger risk exposure, or acquisition planning. First, the disclaimer: this video is for educational purposes only. It's not tax or legal advice. Everyone's situation is different, and these strategies especially require a professional who knows how to design and implement them properly. In this video, I'm going to quote a lot of code sections so you can easily Google them and do some additional reading on your own if one of these catches your interest. All right, let's dive in. Strategy number 1, using a C corporation for medical reimbursements. A closely held C corporation can establish an accident and health plan, such as the medical reimbursement arrangement, for its employees, including owner employees and their families. The corporation pays for medical expenses, and these payments can be deductible by the corporation as a business expense while being excluded from the employee's gross income if certain requirements are met. Relevant rules here: IRS Code Section 105. The amounts received by an employee under an accident or health plan attributable to employer contributions are generally included in gross income, except to the extent they reimburse the employee for medical care expenses as is defined by Code Section 213D for the employee's spouse, dependents, and children under 27. This exclusion does not apply to self-employed individuals, but does apply to owner employees of C corporations who are treated as employees. Internal Revenue Code Section 162A, the corporation can deduct ordinary and necessary business expenses, including employee compensation and benefits such as health plan contributions. Here's an example with numbers. Suppose you own 100% of a C corporation. You and your family incur $20,000 in qualified medical expenses in the year. The corporation has set up a medical reimbursement plan and pays the $20,000 directly to you or to the medical providers. Either way works. The $20,000 is deductible by the corporation as a business expense under Code Section 162A. The $20,000 is excluded from your gross income under Code Section 105B, provided the plan is properly structured and the expenses are for qualified medical care. If the corporation is in the 21% bracket, the deduction saves $4,200 in corporate tax. You and your family receive $20,000 of medical benefits tax-free. Here's some caveats. The plan must not discriminate in favor of highly compensated employees if it is self-insured, or the exclusion may not apply to those individuals. So oftentimes people do this with a C corporation that does not have employees other than the owner or their family for this reason. S corporations, shareholders, and sole proprietorships are not considered employees for this purpose, so the strategy only works for C corporation. If your family has significant ongoing medical expenses, this strategy might be worth looking into. It could potentially save you significant tax in that situation. Strategy 2, Puerto Rico tax incentives. This one gets a lot of buzz in certain circles, but most people don't realize how real the savings can be if you actually qualify. Here's how it works. Puerto Rico offers unique tax incentives for bona fide residents and businesses under what's called Act 60. It's formerly Acts 20 and 22. It's now Act 60. Qualifying individuals and businesses can benefit from a 4% corporate tax rate on eligible business income and 0% tax on certain investment income, provided strict residency and business activity requirements are met. Here's the relevant rules. Internal Revenue Code Section 933. U.S. citizens who are bona fide residents of Puerto Rico for the entire tax year can exclude Puerto Rican source income from U.S. federal income tax. Bona fide residency requires passing 3 tests. There's a physical presence test, at least 183 days in Puerto Rico per year. Your tax home, you must not have a tax home outside of Puerto Rico. And closer connection. You must have a closer connection to Puerto Rico than to the U.S. or any foreign country. Act 60. Puerto Rico's local tax law provides a 4% corporate tax rate for eligible export services and a 0% tax on certain capital gain and dividends for bona fide residents. Some caveats here. You must truly relocate and meet all residency tests. U.S. source income and income effectively connected with a U.S. trade or business remains subject to U.S. tax. The IRS scrutinizes these arrangements, and failure to meet the requirements can result in significant tax and penalties. This is not a loophole or a quick fix. It's a serious lifestyle and business decision. For the right person, though, it can be life-changing. Strategy number 3, captive insurance companies. This is one of the more advanced plays. If your business is large enough and you're self-insuring against certain risks anyway, setting up a captive insurance company can allow you to turn that into a structured, tax-advantaged strategy. Essentially, you're creating your own insurance company to cover risks your business faces. Done properly, this can shift profits into a different business environment and give you more control over your risk management. But again, it's complex, it's heavily regulated. You need a professional team to set it up and run it right. A business can form its own insurance company, what's called a captive, to insure its own risks. And if it's structured properly, the business can deduct insurance premiums paid to the captive, and the captive can accumulate income at favorable tax rates, very favorable tax rates. However, the IRS closely scrutinizes these arrangements for abuse. So relevant rules here: Internal Revenue Code Section 162A, premiums paid for insurance are deductible as ordinary necessary business expenses if the arrangement constitutes insurance in the commonly accepted sense. Again, a lot of hoops to jump through here. Internal Revenue Code Section 831B, small insurance companies with premiums below a certain threshold can elect to be taxed only on investment income, not on underwriting income. Caveats: the arrangement must constitute real insurance, risk shifting, and risk distribution. The IRS is aggressively auditing and litigating abusive tax insurance structures, and penalties for non-compliance can be severe. So those are 3 examples of more niche, under-the-radar strategies. They're not everyday tools. They're definitely not for every business owner. But what I love about sharing these is that they expand your sense of what's possible. The tax code is full of opportunities. The challenge is matching the right strategy with the right situation. This brings us to the end of this series. I hope these videos have given you some fresh insights, not just into what's overhyped out there, but also into the quieter, less flashy strategies that can really move the needle when used in the right way. As always, if you're a client and you want to explore how these apply to your business, let's talk. And if you're not a client yet, but you're running a successful business and you want to see how our broader services might help you, feel free to reach out. Thanks so much for following along, and I'll see you in our next series.